crude oil prices have violently breached $110 a barrel, pushing global gasoline to multi-year highs. The cause? Conflict has locked down the Strait of Hormuz. Unable to safely navigate, a massive volume of the world's daily oil supply shrinks to a trickle. Amid this chaos, the United Arab Emirates made an announcement that shocked energy markets. After 60 years, they are exiting OPEC to act completely independently. Overnight, this removes 15% of OPEC's total production capacity. The cartel relies on controlling a massive share of the market to keep fuel prices high, and losing a producer this size threatens the global pricing system of nearly everything we buy. To understand why this matters, you have to look at what the Organization of the Petroleum Exporting Countries actually does. OPEC functions like a central bank for the global oil market. They tightly control how much oil their member nations are allowed to pump. This seesaw diagram demonstrates their exact strategy. By imposing strict production quotas, meaning they artificially limit the supply of crude oil on the market, they guarantee high profit margins for their member nations. If supply drops, they force the price up. The UAE formally joined this alliance back in 1967. For over half a century, they have been a compliant foundational member, accumulating immense wealth through this collective pricing strategy. Breaking a 60-year, highly profitable alliance requires a serious catalyst. Abu Dhabi realized that the internal benefits of the cartel were suddenly eclipsed by a very real existential threat to their economy. That threat arrived during the recent Middle East conflicts. Iran began direct military targeting of UAE oil infrastructure, hitting critical refineries and ports sitting entirely exposed. When the missiles started flying, the UAE expected support. Instead, they faced a stark lack of military or diplomatic response from both their traditional Gulf allies and their Western security partners. This triggered a severe strategic realization in Abu Dhabi. Depending on a slow, consensus-based cartel for economic security is a massive vulnerability when your borders are actively threatened. The UAE is choosing full sovereign autonomy over cartel loyalty. They are prioritizing immediate national survival and defense capabilities over group profits. But there is also a massive economic friction at play here. Led by figures like Energy Minister Suhail al-Mazroui, the UAE has poured $150 billion into boosting its crude oil production capacity, with a target of 5 million barrels a day by 2027. OPEC's strict quotas acted as a straitjacket. They forced the UAE to leave billions of dollars of that new, expensive capacity completely unused, just to protect the cartel's artificial pricing. The UAE has a very clear endgame. They want to rapidly monetize their massive oil reserves right now, using that cash to fund a transition into a post-oil economy dominated by artificial intelligence, advanced tech sectors, and luxury real estate. To build the technology-driven economy of tomorrow, they need vast amounts of capital today. They quickly realize they simply cannot afford to be held back by the production limits of yesterday's cartel. In the immediate aftermath of this exit, markets are panicking. We are seeing high volatility and short-term inflation, which is incredibly painful for importing nations. But the long-term reality looks very different. Without OPEC quotas holding them back, the UAE is free to aggressively flood the market with millions of unrestricted barrels of oil. Basic economics takes over from there. A massive independent supply injection will dilute OPEC's market share, weaken their collective grip, and exert immense downward pressure on global energy costs. This creates a unique opening for India. As a nation that imports roughly 85% of its daily oil needs, India is highly vulnerable when crude spikes past $110. This comparative bar chart shows exactly how India prepared for this exact scenario. While neighboring countries are running on near-zero commercial reserves, India is sitting on a massive buffer of 60 to 70 days of strategic petroleum reserves. Because India has the reserves to wait out the short-term panic, they can capitalize on the new diplomatic landscape. Free from OPEC's collective pricing rules, the UAE can now negotiate direct, preferential bilateral deals with massive buyers. We are already seeing rapid diplomatic moves. High-level security and strategic negotiations are taking place between New Delhi and Abu Dhabi to secure independent supply chains, completely outside of cartel oversight. India is turning a global supply shock into a multi-billion-dollar strategic advantage. By negotiating directly with the UAE, they bypass the cartel entirely. These new bilateral deals also activate the broader CEPA trade agreement, opening the door for the oil for rupee trade mechanism. When India buys UAE oil directly using rupees, it completely sidesteps the US dollar. This mechanism directly accelerates the global trend of de-dollarizing international trade. The rigid petrodollar cartel is fracturing. As major producers prioritize their own sovereign interests over group quotas, emerging economies are stepping up to dictate the new terms of global energy.